Welcome to the Opening Bell Report.
We're looking at what I like to call a slow burn.
Right, a macro trend that's been quietly building.
Exactly. Or, a piece of tech that's just slowly creeping into our lives. But today
is different.
Today we are looking at something that feels a bit more like a stick of dynamite going off.
It really is. It's a shock to the system, especially if you just glance at the headlines.
We are unpacking a comprehensive analysis report on MP Materials. And if you've been watching the charts, you might have done a double take recently.
Oh, for sure.
The stock didn't just go up, it gapped up. It surged over 5% in a single session, just smashing through these resistance levels.
Levels that have been like a concrete ceiling for months. It's the kind of move that wakes up the algorithms. But here's the catch, and this is what makes this report so fascinating. If you look at the company's bank account, well, strictly speaking, they are losing money.
Right. And that is the paradox we need to figure out today.
Yeah.
Why on earth is Wall Street piling back into a company that is posting a net loss? It feels upside down.
It does.
The old rule is simple. You buy companies that make profit. You sell companies that lose money. That's investing 101, isn't it?
Usually, yes. That's the textbook definition.
Yeah.
But the market is a forward-looking machine. It doesn't care about yesterday.
It cares about tomorrow.
Exactly. And this analysis report, which they've titled the Mountain Pass Blueprint, suggests this net loss might actually be one of the most bullish signals you could ask for.
If you know how to read the blueprint.
If, and only if, you know how to read the blueprint.
So that is our mission. We are going to deconstruct this report. We'll explore the three massive catalysts that the analysis says are driving this thing. We're going to figure out why losing money might be a strategic masterstroke, which still sounds risky to me, but I'm listening. And we'll look at why analysts are suddenly projecting a run up to $76.
It's a classic case of looking past the headline numbers to understand the architectural shift underneath.
Okay, so let's start with the price action, because the report makes a big deal about how this stock moved.
Right. It wasn't a slow, polite climb.
No.
It was decisive, aggressive even. We're talking about a close at $66.73.
That's up $3.29, or about 5.2% in one day.
And honestly, the percentage matters less than the shape of the recovery.
The report calls it a V-shaped reversal. Okay, so for the listeners who aren't technical analysis wizards, and I include myself in that group half the time, why does the letter V matter here?
Well, in technical analysis, a V-shape is powerful because it represents a psychological snapback.
A snapback.
Yeah, imagine holding a beach ball underwater. You push it down, fighting the pressure, and the moment you let go, it just rockets up. That's a V-shape. It indicates sentiment didn't just drift, it shifted violently from bearish to bullish. And critically, the report points out that this surge broke above both the 50-day and the 200-day moving averages.
I see those terms thrown around constantly. The 200-day moving average. It sounds like astrology to some people. Why should an investor actually care about that line?
Think of them as the psychological battle lines of the market. The 200-day is the long-term trend. It's the climate, not the weather.
Okay.
When a stock is below it, it's in the penalty box. It's officially in a downtrend. Algorithms are often programmed to sell any rips. But breaking above it,
that's different.
That's like breaking through a glass ceiling. It tells institutional investors, the winter is over. The climate has changed.
So it triggers the automated buying. It's just a green light for the machines.
Precisely. And speaking of big money, the report emphasizes the volume profile. This wasn't a bunch of retail traders clicking buy on their lunch break.
Not a meme stock rally.
Not at all. The stock opened at $63.57 and it climbed steadily. It hit an intraday high of $68.
And the analysis says that steady climb is important.
It's crucial. If a stock spikes in the morning and then crashes back down, that's just noise.
Day traders flipping coins?
Right. But when buyers step in at the open and hold that pressure all day long, driving the price up and keeping it there, that shows high conviction.
It means the big funds were buying.
The institutions, mutual funds, pension funds were accumulating shares, and they weren't waiting for a bargain. They wanted in now.
So they were just grabbing whatever supply was available.
Exactly. That is a sign of accumulation, not just speculation.
Okay, so the what is a massive high conviction breakout. The technicals look great, but now we have to get to the why. Because I'm still stuck on the fundamentals. The report explicitly says revenue is down 15% year over year. Net income is negative. If I ran a business and told you that, you wouldn't invest in me.
No, I would not.
You tell me to fix my business.
If it were a bakery or a shoe store, absolutely, I'd be worried. But this brings us to the first major catalyst in the analysis, the J-curve thesis.
The J-curve? Sounds like a roller coaster.
It essentially is. The J-curve describes a specific trajectory. Things go down sharply before they hook and go exponentially up.
Okay.
And the report describes MP Materials as being deep in the investment valley right now.
The investment valley. That sounds ominous. It sounds like a place where money goes to die.
It's actually where value is created, but it's painful to watch from the outside. Look, back in 2022, MP was profitable. They were making money hand over fist.
So what changed?
They were just digging stuff out of the ground, rare earth concentrate, and selling it to China for processing.
The report calls that easy money.
It is easy money. It's a commodity business. You mine the dirt, you ship the dirt. Low overhead, immediate cash. But MP Materials decided that wasn't enough.
They wanted more.
They realized that selling the dirt gets you pennies, but selling the finished product that gets you dollars, they want the full value chain. They don't want to just sell the flour, they want to bake the bread.
So they want to make the actual finished products, the magnets and things.
The separated oxides, neodymium and praseodymium, and the actual finished magnets used in EVs and fighter jets. That is the big money.
But to get there, you have to build the factories. These aren't simple factories, right?
No, this is extremely complex chemical engineering. Separating rare earths is notoriously difficult, it's toxic if done wrong, and incredibly expensive.
Ah, so that's why the numbers look ugly.
Exactly. They deliberately stopped selling as much of the easy raw concentrate. They're hoarding it to feed their own refining facilities that are just now being built and ramped up.
The report used an analogy here that I loved. It said, it's like closing a lemonade stand to build a juice factory.
It's the perfect analogy. Let's just play that out for a second. Imagine you have a lemonade stand on the corner. You're making $100 a day. You're profitable, but you have a vision. You want to sell bottled juice to supermarkets nationwide.
Huge scale, a total transformation.
Right. But to do that, you have to shut down the stand. For a year while you're building, your revenue goes to zero. Your costs go through the roof.
And your neighbors are looking at the construction site, the dust and the noise, and they're thinking, wow, he's failing.
He used to make money. Now he's losing money every single day.
But you're not failing. You're investing. Yeah. You're building capacity. You're sacrificing the nickel today for the dollar tomorrow.
Precisely. And when you reopen, you aren't selling cups for $1. You're selling pallets for thousands. The report argues that MP Materials is just about to reopen the factory.
The construction fences are coming down.
They're exiting the investment valley.
So the smart money buying right now, they aren't looking at the fact that the lemonade stand is closed. They're looking at the juice factory that's about to turn on the lights.
Correct. They are buying the future cash flow of the magnets and the separated oxides. These products have much, much higher margins than the raw dirt.
They want to buy at the bottom of the J.
Before the vertical ascent.
That makes a lot of sense. It's a pivot. And pivots are always messy on a balance sheet.
They are.
Okay, so that's the internal catalyst, the J curve. But there's an external catalyst here too, right?
Yeah.
The report talks a lot about America first, not as a political slogan, but in terms of industry.
This is catalyst number 2, and honestly, this might be even more powerful. This is the geopolitical premium.
We're talking about national security.
We are. You have to remember, the rare earth supply chain it's heavily dominated by China.
How heavily?
Depending on the mineral, China controls anywhere from 80 to 90% of the processing. We're talking about the materials for high-performance magnets. Without them,
EVs don't work.
EV motors don't work, wind turbines don't spin efficiently, and most importantly for the Pentagon, F-35 fighter jets don't fly. Guidance systems on missiles don't guide.
That sounds like a glaring vulnerability. If you're a military strategist, that has to keep you up at night.
Yeah.
And where is MP Materials in this picture?
They are the only scaled producer of these materials in the entire Western Hemisphere.
The only one in all of North and South America.
The only one with significant industrial scale. That creates what the report calls a moat. And it's not just a business moat, it's a national security moat.
And the government is involved?
The Department of Defense, the DoD, has direct partnerships with MP. They have put actual taxpayer money into this company. They need MP to succeed.
Because if MP fails, the U.S. is 100% dependent on a potential adversary for critical defense components.
Exactly. And that puts a floor under the stock price that doesn't exist for, say, a normal mining company. If MP starts to wobble, the U.S. government has a vested interest in propping them up.
So when the report talks about investors paying 50 times sales, which is a huge premium, is because they aren't just buying earnings.
Right. The report argues they're buying a national security asset. You pay a premium for insurance. Owning MP is like owning an insurance policy on the U.S. supply chain.
That is a fascinating way to look at it. It's not just PE ratios, it's P geopolitics.
It allows the stock to trade at a valuation that would look insane for a company selling, I don't know, T-shirts.
Scarcity commands a premium.
It does.
Now, The report doesn't just look at MP in a vacuum. It brings up a competitor, a company called Lynas.
Lynas is the benchmark in the industry. They're an Australian company, but their processing plant is in Malaysia. For a long time, they were the only major non-Chinese player.
Okay, so how do they stack up against MP? If I'm an investor, why choose one over the other?
Well, looking at the stats, Lynas is the safe play. They have plus 18% growth. They're profitable right now. They even pay dividends.
They're the mature business model.
It's a horizontal model mine in one place, process in another, sell to the market. They're the adult in the room.
So if you want safe, steady exposure, you buy Lynas. They're the blue chip of the sector.
Generally, yes. But then you look at MP, the report labels MP the rocket ship.
Because of the risk-reward profile.
Exactly. MP has minus 15% growth right now. That's the lemonade stand being closed, right? But they are building a fully vertically integrated supply chain right here in the USA. From the mine in California to the magnet factory in Fort Worth, Texas.
So everything happens on U.S. soil. Digging, refining, magnet making.
Everything. Mine to magnet. And the market expects that once those Fort Worth facilities come online, MP's growth is going to explode past Lynas.
It's the difference between a company that's fully grown versus one that's just hitting its teenage growth spurt.
That's the synthesis, and the report clearly favors MP's valuation, despite the lack of current profits, because the ceiling for MP is just so much higher.
The upside potential is larger because they capture margin at every single step. So let's look at the crystal ball. What does the analysis say about where this is going? We're trading around $66, $67 now.
The consensus is incredibly bullish. The report highlights strong buy ratings across the board. The price targets are in the range of $76 to $79.
So even after this 5% pop, they're still seeing another, 15% upside?
At least. And that's just the near-term target. The analysis argues that the ugly numbers on the income statement are temporary. They believe the bottom is in.
And the chart confirms it with that V shape.
It does.
And the vision for the long term, say 2027.
That is the key date. The thesis is simple. If you believe in the EV transition, and if you believe that the U.S. and Europe will continue to push for independence from Chinese supply chains,
then MP at $66 could look like an absolute steal by 2027.
Because by then, the factory is open, the juice is flowing, the DoD contracts are active, and they are the dominant Western player in a critical industry.
But let's play devil's advocate for a second. What if the EV market slows down? We've seen some of those headlines.
That is the risk. If EV adoption craters, MP hurts, no doubt. But remember the F-35s.
The defense and industrial side?
Remember the wind turbines, the robotics. Magnets aren't just for Teslas. They're the muscles of the modern economy.
But the defense demand provides a very sturdy safety net.
The U.S. military is not going to stop building jets because the consumer car market is a little slow.
It's a compelling narrative. It really ties together the chart movement with the actual business strategy.
It does. It shows why you can't just trade off a spreadsheet. If you just looked at net loss, you'd sell.
But if you look at building the juice factory, you buy. So let's recap. We started with a massive stock surge, a V-shaped recovery on high volume.
Right. A signal that the big institutions are buying in with conviction. The bottom is in.
Then we looked at the why. First, the J curve. MP is transitioning from easy money to big money.
They closed the lemonade stand to build a factory, and smart money is betting on the reopening. The investment valley is ending.
And second, the America First premium. MP is a national security asset backed by the DoD.
Justifies a premium valuation. It's the geopolitical put option, value driven by necessity.
And finally, compared to Lynas, MP is the high-reward rocket ship play focused on total U.S. vertical integration.
Exactly. Lynas is for preservation, MP is for acceleration. It's a lot to think about. You know, it makes me wonder how we define value in the market. We are so trained to look for immediate profit.
We're obsessed with the now. We have attention spans of about 3 months.
But this report suggests that sometimes the most valuable time to buy a company is exactly when it looks like it's failing.
When the close for renovation sign is up.
Right.
That is often where the real alpha is. The crowd sees a closed store and walks away. The visionary sees the blueprint for the skyscraper that's replacing it.
So here's a question for you to mull over. We've talked about MP Materials as the lemonade stand closed for renovation. Are there other companies out there that are currently losing money, not because they are failing, but because they are building something bigger?
Are there other lemonade stands out there that the market is ignoring because they aren't selling cups right this second?
That is the million-dollar question.
Identifying the difference between a company that is broken and a company that is building. That's the key to investing. Absolutely. Thanks for diving deep with us today. It's been a fascinating look at the mechanics of a market surge.
Always a pleasure to connect the dots.
We'll catch you on the next one. Keep looking for those blueprints.
Don't forget to like, share, and subscribe for more.